Right now, the stock market is sending you a signal, but most people are missing it. The Dow just jumped over 800 points, yet the Nasdaq is getting hammered. Bitcoin is down nearly 20% this month, and Social Security checks could be $500 smaller every single month in just 6 years. So where should you actually put your money today? Stick around, because we're breaking down the exact opportunities and risks in today's market. Hey, welcome back to Money Mindset TV. If you're new here, we break down what's actually happening in markets right now. Not what happened last year, not theory, but what's working today. So if you care about building real wealth in 2026, hit that subscribe button, because this is the kind of current market intelligence most people pay thousands of dollars for. Let's talk about what happened this week. The S&P 500 is up 5.2% just this month. The Nasdaq 100 is up nearly 10%. But here's the thing. That headline number is hiding what's really going on underneath. This isn't a broad market rally where everything is going up together. This is a rotation. Money is running away from certain places and rushing into others. And if you don't understand where that money is flowing, you're going to make expensive mistakes. Broadcom just reported earnings, and the market absolutely punished semiconductor stocks. Chip stocks are getting destroyed because investors are asking a really hard question. Are we overvalued? Are we pricing in too much AI optimism too early? That's a legitimate concern. You've got Broadcom missing expectations, and suddenly money that was in semiconductor ETFs is looking elsewhere. So where is it going? Into banks and retail stocks. The Dow is up 5.5% this month because old-school value plays are having a moment. Financial services, consumer discretionary, these are catching bids right now. Here's what this tells me. We're not in some euphoric everything goes up market anymore. We're in a market where winners and losers are being decided very quickly. That's actually good news for you if you're paying attention, because it means there are real opportunities instead of just riding coattails. So let's talk about where you should be putting money right now, and let's be honest about the risks and opportunities. First, broad market exposure. If you're not a day trader, if you're a regular person trying to build wealth, you need core holdings in index funds. A total market index fund, or S&P 500 fund, is still one of the best set-it-and-forget-it vehicles. On platforms like Fidelity, Vanguard, or Charles Schwab, you can open an account in literally 5 minutes. The S&P 500 is at 755.48 right now, and we're still seeing upward momentum for the month. But here's the reality check. Valuations matter. The broader market is pricing in a lot of optimism. So if you're starting a new position, consider dollar cost averaging. Invest the same amount every month instead of dumping everything in at once. That way, if there's a pullback, you're buying the dip automatically. Second, sector rotation is your friend right now. The fact that money is flowing out of semiconductors and into financials and retail tells you that large cap tech might be taking a breather. That doesn't mean you sell all your tech. It means you look at diversification. Consider adding bank stocks or retail ETFs to your portfolio. Vanguard and iShares both have solid sector-specific ETFs that let you capture these rotations without picking individual stocks. You're looking at rotation, not collapse. This is normal market behavior. Third, bonds are actually worth looking at again. If you've been avoiding bonds for the last few years, we're in a different environment now. Bond yields have stabilized, and you're getting real returns that actually beat inflation. A simple bond fund or treasury ladder could anchor the stable side of your portfolio. This is especially true if we're in a period where the Fed isn't going to be cutting rates aggressively. And Peter Navarro just told the Fed, don't even think about rate hikes, which tells you the political pressure is real. Regardless of what happens, bonds are no longer returning basically nothing. Now let's talk about what's not working right now. And you need to hear this. Bitcoin is down 19.6% this month. Gold is down 1%. Crypto is going through one of those cycles where it stops being a diversifier and starts being something that correlates with risk sentiment. If you're holding crypto, don't panic, but don't add to crypto positions expecting it to be a hedge right now. Bitcoin is volatile, and volatility can be profitable if you know what you're doing. But for most people, crypto should be a small percentage of your portfolio, maybe 2 to 5% max, and money you can afford to lose. Gold's performance is also a reminder that commodities aren't always the safety play they used to be. Down 1% might sound small, but historically, gold does better when real rates are falling or when there's systemic risk. Right now, the market doesn't smell systemic risk, so gold is treading water. This actually tells you something. The market is relatively confident. That's a signal you should pay attention to. Here's something that nobody's talking about enough, and it's going to affect millions of Americans. Social Security is in trouble. Not in some distant future, right now. Checks could be cut by nearly $500 per month by 2032 if Congress doesn't act. That's about 6 years away. If you're planning retirement around current Social Security benefit levels, you're going to be shocked. What does this mean for your investment strategy? It means you can't count on Social Security being what you think it is. You need to be more aggressive about building your own wealth while you can. That means maxing out your 401k. The limit is $24,000 this year. It means being serious about your Roth IRA. Which brings me to something that just came up. Trump accounts creating a legal backdoor for Roth IRA wealth. Tax attorneys are saying there's a strategy emerging where you can use certain account structures to dramatically increase tax-free growth. This is technical stuff, and you should talk to a CPA or tax attorney if you're looking at this, but the point is, tax-advantaged retirement savings is becoming more important, not less. Your taxes are going to matter more and more, so understanding vehicles like Roth conversions, backdoor Roths, and mega backdoor Roths is not optional if you're serious about wealth. Okay, so here's your action plan for the rest of 2026. First, audit your portfolio right now. Where is your money? Is it in index funds, individual stocks, crypto, real estate? Write it down. Look at what percentage is in each bucket. Most people don't even know. Second, if you don't have a diversified core of index funds, start there. Open an account on Fidelity, Vanguard, or Charles Schwab, doesn't matter which, they're all solid, and start with a simple 3-fund portfolio: U.S. total market, international developed markets, and bonds. Third, start thinking about sectors that are rotating into favor right now. Financials are hot. Retail is catching bids. Look at ETFs like XLF for financials, or XRT for retail if you want sector exposure. Fourth, if you're under 50 and have a long time horizon, this market rotation is actually your friend because it means volatility is happening, which means opportunities to buy dips. The worst thing you can do is sit in cash because you're scared. Cash earns basically nothing, and inflation still exists. Fifth, get serious about your retirement accounts. Max out your 401k if you can. If you're self-employed, look at a solo 401k or SEP IRA. If you're thinking about that Roth conversion strategy, get a consultation with a tax professional. This is the time to be strategic about taxes, not reactive. Sixth, and this is important, don't chase the Broadcom earnings collapse into some other tech stock thinking you're getting a bargain. Sector rotations can last months or years. Just because chips are down doesn't mean they're oversold or ready to bounce. Let the market prove direction before you swing positions. Here's the big picture. The market is healthy right now. We're seeing differentiation between winners and losers, which is what healthy markets do. You're not seeing a crash. You're seeing rotation. That's actually the best environment for regular investors because it means you can build positions steadily without the panic of a collapse. But it also means you need to be thoughtful. You can't just buy and forget anymore. You need to understand what you own and why. The fact that Americans' financial literacy just hit a 10-year low, according to CBS News, tells me that most people don't understand these dynamics. Most people are confused about where to put money. Most people are sitting in cash earning nothing because they don't know what to do. That's why you're watching this. You're already ahead of the curve just by trying to understand what's happening in real time. So here's what I want you to do. First, subscribe to this channel if you haven't already. We're publishing market updates constantly, and in a market like this, staying current matters. Second, comment below and tell me, what's your biggest question about where to invest right now? Are you worried about inflation? Are you sitting in too much cash? Do you have exposure you're not comfortable with? Let's talk about it in the comments. That's how we keep this channel real and actually useful for people. Third, if you found this valuable, please share this with someone who needs to hear it. Your friend who's sitting in cash. Your coworker who thinks the market is too risky. This is the kind of conversation that changes people's financial lives, and you can help spread that. We're in a fascinating moment in the market right now. Money is moving, opportunities are opening, but only if you know where to look. Thanks for watching Money Mindset TV. We'll see you in the next one.